Hey everyone, welcome back. Today, we're diving into the global markets. The signals are all over the place, and it's creating a lot of confusion. I'm going to break down what's happening with liquidity, crypto, and commodities. Let's get started. Alright, let's start with today's main focus. The core contradiction is that everything seems to be sending mixed signals. On one hand, we have crypto where Bitcoin's funding just turned positive, but Ethereum's has been negative for a week. On the other hand, gold is flying high, but oil is crashing. It's like the market can't make up its mind. So, what does this mean for our trades? Let's dig into the data. Let's look at the key data first. The market's expectation for a rate cut in June is now just 1.5%. That's almost zero. So, I think we can safely say the Fed isn't cutting rates anytime soon. Meanwhile, the dollar index is down a bit. A weaker dollar is usually good news for things like stocks and crypto. But as we saw, other signals are conflicting. Now, let's check the liquidity situation, which is my main focus. The on-RRP balance has dropped by a massive $190 billion. It's now at $387 billion, getting dangerously close to our warning zone. Similarly, bank reserves are still below the crucial $3 trillion mark. This tells me the liquidity buffer is thinning out rapidly. Let's move to commodities. Gold is up over 3% today, breaking past $4,200. That's a huge move. It shows investors are rushing to safety. But at the same time, oil is crashing over 5%. This is the classic risk-off trade. The market is essentially betting on both a safe haven and a recession at the same time. It's a very confusing picture. Finally, let's look at crypto. Prices are relatively stable, with small gains. But the real story is in the funding rates. Bitcoin's funding just turned positive, meaning longs are starting to pay. Ethereum's has been negative for a week, meaning shorts are paying. This divergence is rare and tells me a big move is coming. Also, sentiment is still in fear territory, which isn't surprising given the uncertainty. So, summarizing the liquidity conditions. The on-RRP is falling quickly, bank reserves are below the danger zone, and the government is sucking money out via the TGA. Put simply, the liquidity buffer is getting thinner and thinner. This is the most important thing I'm watching right now. A system with less liquidity is more prone to shocks. But it's not all bad news. There's one positive sign I want to highlight. The outflows from Bitcoin and Ethereum ETFs have narrowed dramatically. From hundreds of millions to just tens of millions. This tells me that the big institutional selling might be slowing down. If we get even one day of inflows, it could be a sign that the bottom is in. Now let's get into the key signals I'm watching. The strongest one is the complete divergence in crypto funding rates. Bitcoin's just turned positive, meaning bulls are active. Ethereum's has been negative for a week, meaning bears are getting squeezed. This is a rare setup. Historically, when this happens, the market chills out and waits for one side to prove itself right. The second signal is the extreme divergence in commodities. Gold is screaming safety, while oil is screaming recession. It's like two different markets are trading at the same time. I've seen this kind of divergence before, and it usually means a big move is coming once the market figures out which story is correct. Right now, risk assets like crypto are stuck in the middle. The third signal is the positive one we touched on earlier. The ETF outflows have shrunk a lot. This is a big deal because it means the big money isn't selling as aggressively anymore. In the past, when we see outflows narrow like this, it's often a sign that a bottom is forming. If this trend continues, it's very positive for crypto. So, given all these mixed signals, what happens next? I see three possible scenarios. The most likely one, in my opinion, is an Ethereum short squeeze leading the market higher. The second is more of the same choppy consolidation. And the third, less likely scenario, is a full-blown macro panic taking everything down. Let's break each one down. Scenario A, which I give a 50% chance, is that the Ethereum short squeeze takes over. For this to happen, ETH's funding needs to stay negative for a bit longer, and Bitcoin needs to hold its support around $62,000. If this plays out, I expect Ethereum to lead the charge, and Bitcoin could follow it up towards the $66,000 to $68,000 range. Scenario B is more of the same. I think there's a 30% chance the market just continues to consolidate. This would happen if the mixed signals keep coming and the VIX stays elevated. In this case, I expect Bitcoin to trade sideways between $62,000 and $65,000, just waiting for something to break the deadlock. Scenario C is the bearish one, with a 20% probability. This is the macro panic scenario. If we see the VIX spike above 25, gold break $4,300, and oil crash below $85, it means fear is taking over. In this case, all risk assets, including crypto, would be under pressure, and I'd expect Bitcoin to test lower levels around $58,000 to $60,000. Let's recap the anomaly signals because they're so important. First, Bitcoin and Ethereum funding are pointing in opposite directions. This is rare and means the market is confused. Second, gold and oil are moving in extreme opposite directions. This is like the market is hedging for two completely different outcomes at once. These anomalies are why I think we're at a critical juncture. So, if I had to sum up everything in one sentence, the market is stuck in consolidation due to conflicting short-term signals and extreme commodity divergence, while ETF outflows are showing a glimmer of hope. The most likely path is more of the same until a clear catalyst emerges. We need to watch which side breaks first. To wrap up, here's my watch list for the coming days. First, I'm laser-focused on the ETH funding rate. If it stays negative, a squeeze is likely. Second, I'm watching the BTC funding rate to see if the new positive trend holds. Third, ETF flows are critical to see if the selling pressure is truly gone. And finally, keep an eye on the VIX and gold levels for any signs of increasing panic. Just a quick reminder, everything I've discussed today is based on data from sources like the Federal Reserve and CME. This is for informational purposes only and is not financial advice. The market can change quickly, so always do your own research.